Taxes in Retirement Live. We got an exciting one for you this week. I'll be talking all about bonds and bond funds. Before we get into it, let me do some mandatory, obligatory dad jokes. I will start with, it's my wife's birthday soon, and she's been leaving jewelry catalogs all over the house. So I've taken the hint. I got her a magazine rack to put those jewelry catalogs away. Next, 2 years ago, my doctor told me I'd go deaf. I haven't heard from him since. It's terrible. And finally, I told my daughter, go to bed, the cows are sleeping in the field. She said, what's that got to do with anything? I said, that means it's pasture bedtime, because cows in the pasture. Oh, hey, Mavis. I see Mavis is waving. Excellent. Comments are working. Thank you. Hopefully you enjoyed those jokes. Disclaimer. This video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see or hear here, first consult with your tax, legal, or investment advisor. Thank you very much. All right, so bonds. This is going to be a good one for a handful of reasons. First, it's going to be hard to jam into an hour or so, everything there is to know about bonds, or at least everything important to know for purposes of our group and kind of high-level education about bonds. But nonetheless, I'll try my best. I do have a sketched out outline of things to talk about. I'm assuming there'll be a lot of questions, so if and when I get kind of diverted and off topic, I apologize in advance, but I suspect that a lot of this conversation will be driven by your questions as opposed to me just running through my pre-canned list of things I wanted to talk about. Some initial thoughts about bonds. So I think most people generally know about stocks, know what they are, know more or less how they function, and understand them to a good extent. Often not the case with bonds. A handful of reasons for that. I think partly I blame CNBC. They romanticize and glamorize stocks to the point that it's overkill. It's too much. So all the bright screens you see in the background of CNBC and people on the floors, moving, shaking hands, that's largely all for show, for entertainment. You don't need any of that stuff. You don't need big, bright, vivid signs that say Cisco or Microsoft or whatever. That's just stage props. And there's nonstop noise and commentary and news about stocks all day long on the likes of CNBC and various blogs and Facebook groups and whatever. People love to talk about it. People, make it more complicated than it is. It's fun to watch. I admit it's fun to follow stocks, and it's part gambling. It's part exciting. But anyway, everyone sees and understands stocks. They trade on an exchange. It's simple and easy to set up a brokerage account to buy and sell stocks. Bonds are very different. The bond market is actually substantially larger than the stock market. I don't have the stats with me, but this was something I presented in my class when I taught this a handful of years back. The aggregate size of all bonds in the world is like multiple trillions of dollars more than the market cap or size of the global stock markets, yet people don't know that. So for various reasons, especially in the institutional investment world, bonds are a big deal, more so than you would think they are. From a retail perspective, most people don't know much about them, but that doesn't mean bonds aren't exceptionally important. Just looking at the comments here, see what we got. So Beth asked a good one. I guess I'll get to it now. It may be a little premature given we didn't run through the rest of the stuff, but Beth asks, how would bonds be affected by a devalued dollar? Ugh. I guess it depends. So directly, this is going to be complicated. If you have a bond denominated in U.S. dollars, then it wouldn't necessarily matter. Let me hold that question actually, Beth. I think it'll be better answered towards the end after we discuss like how bonds actually work and what they're made up of and things like that. But that's a great question. So thank you for that. So some of this may be pretty elementary and high level for some of you. Some of you may be like, wow, this is the most informative thing I ever heard. So we'll see. Then maybe people are in between as well. So at a high level, what is a bond? It's basically an IOU. It's when a company or a government or a municipality needs to raise money for something. They go out and basically take out a loan. They say, hey, I need to raise $1 million. I'm going to raise this money in the form of a bond. What is a bond? They issue, it's a note, an IOU. It says, hey, world, I will sell you, give me $1 million now. In return, I will pay you back that $1 million in 10 years, let's say. And along the way, I will pay you interest. Could be every 6 months, every year, whatever, but I'll pay you interest. So for today's conversation, we're going to stick to regular, what I'll call vanilla bonds. It's something that you pay for it, you buy it now. At the end, when the bond matures, it could be 1 year, it could be 5 years, it could be 10 years. There's bonds with maturities that are all over the spectrum. At the end, at the maturity of that bond, you get some value back, $100, $1,000, whatever the face value or notional value of that bond is, you get back. And then again, along the way, you get interest payments. Those interest payments are technically called coupon payments. Now, why is that? This sort of predates me, but bonds used to be actual booklets you would get where every 6 months or every year you would literally rip off a coupon for that period's interest payment, mail it into the company. They would in turn send you the cash. So that's why interest is called coupons, because it used to be a coupon book of bonds. I'm 42. I've never actually seen a coupon bond. I think some still are kicking around, but all these things reside now in just electronic form. They're the books and records at whatever broker sold you the bond. They keep track of this and facilitate these payments and stuff. Anyway, that's why bond interest payments are called coupon payments. And as I mentioned, there's there's an end date. Unlike a stock, stocks don't have end dates. A company, when it sells shares, those shares, those slices of ownership in the company, last indefinitely until the company eventually liquidates and shuts its doors or goes bankrupt, goes bust along the way. Stocks last forever. Bonds don't. There are some, again, there's lots of flavors of bonds, but the ones we'll be talking about, they have finite endpoints. It'll be 1 year, 2 years, 5 years, 7 years, 10 years, 30 years. Most bonds don't last more than 30 years. There are some 100-year bonds floating around in the world. I think our Mexican government has some, UK government has some. And there are some what's called perpetual bonds, bonds that don't ever end. They'll just pay a coupon payment forever. But most bonds have some finite end date. And again, interest payments, typically every 6 months, these coupons, these interests are paid, or it could be some are monthly, some are quarterly, but 6 months is the most common usually. Sort of an important thing to know, this gets a little technical, but companies have a few ways to raise money. One is they can sell stock. We all sort of know what that is, that they're selling off ownership interest in their company. So those who own the stock literally own slices of ownership in that company. Bonds aren't ownership. Bonds are just loans. When a company sells a bond, issues a bond, they're not giving up any ownership like they are when they sell stock. They're just simply writing IOUs. They're borrowing money with the promise to pay it back. Once it's paid back, boom, the bond goes away, it disappears, it's over. That arrangement's over. It's like taking a loan. Like Cannon says here, a mortgage is actually a bond. Yes, it is. You get a 30-year mortgage on your house. You're not directly giving up ownership. You are if you default. You don't pay your mortgage back, then the bank can step in and take it. But so long as you're making your payments on time and in full, you don't directly give up ownership. You just simply have a loan. If you pay the loan off according to the terms of your loan, at the end, the loan's over. You still keep your house, and the lender goes away. It's over. Your relationship's done. That's what a bond is. Mortgages are usually 30 years. You usually pay month to month. A bond, like I said, could be any sort of maturity, and usually paid on a semi-annual or annual basis. But yeah, conceptually the same. It's just a loan. It's a loan structured as a series of interest payments and then one big fat repayment at the end. That's what a bond is. Pam asked the differences between corporate and municipal bonds. Hold that question. Great question, but I'm going to be getting to that shortly. So bonds have this finite endpoint. Stocks don't. Again, a bond is just a loan for a predetermined length of time. Unlike stocks, almost all bonds do not trade on exchanges. And this is why a lot of people in the retail world aren't that familiar with them and how to get them. It's not like a stock. Anybody can go easily open up an E-Trade account tomorrow and, be day trading. And again, commercials and CNBC glamorize it, and places like Robinhood promote anybody with a pulse and $1,000 or not even $100 to go start trading stocks. That can be dangerous. You don't see platforms like that for bonds because you can't buy bonds through an exchange. Almost all bonds you can't. There are some that are exchange traded, but let's assume they don't exist because that's the exception, not the norm. So bonds trade what's called over the counter. You have to buy them direct from a broker. There's no electronic exchange in the middle. You need to call up, physical, or there's email platforms or whatever. But basically, you need to call a broker and say, hey, I want to buy a bond. How much is it going to cost? What can you get me? Whatever. So it's clunkier and more expensive to trade. There's going to be commissions. It could be $20, could be $50 every time you buy and sell a bond because it is a more manual, involved process with the broker, as opposed to stocks you can trade for free now through any sort of through multiple discount brokers or online platforms or whatever. So bonds, very different in how they trade. Canon, will I talk about preferred bonds and convertible bonds? Wasn't going to. I can. If there's time, I'll get on that, or just reach out to me afterward. I mean, I know those well, but they're kind of beyond the scope for what the vast majority of people actually need to use or consider Canon. But they're cool products. So how do you actually buy a bond? So this depends. And this, I guess I'll get to this now. So different types of organizations can issue bonds. Governments can. The probably biggest issue of bonds out there is the United States Treasury. They raise bonds, they sell bonds to borrow money. Bonds are basically just the government borrowing money to fund its operations. So governments can issue bonds. When you do that, you have an IOU from the government saying they promise to pay you back in full and on time according to the schedule of whatever your bond is. United States Treasury issues bonds as short as 1 week, I think, all the way up to 30 years and various maturities in between. Other major governments issue bonds as well. So governments can issue bonds, federal governments, national governments, as can municipal governments. So states, even towns, local towns could issue bonds. Those are called municipal bonds. Why would they do that? Just like the federal government issues bonds to raise money to fund its day-to-day government operations, local governments can as well. Again, states, local towns, whatever. They raise bonds. Those are called municipal bonds because they're raised by municipalities to fund schools or the construction of a new park or, I don't know, some waste treatment plant. Towns can sell a bond to raise money to build a new waste treatment plant. Those would be municipal bonds. There's interesting angles to those tax-wise. I'll touch on that later on. But that's municipal. Corporations can issue bonds to raise money to build new plants, to buy new equipment, to buy inventory, I guess. Corporations issue bonds, and functionally all the same, whether it's a government, federal government, a state or local government, or a corporation, a bond is a bond. It's an issuer borrowing money, writing a promise that, yes, I will pay you back all of your coupons, and I will pay you back this lump sum of principal money at the end. Those are bonds. Now, for the most part, I'll leave it here. I'll leave it there for now. As far as the issuers, there's also other more complicated bonds like mortgage-backed securities, where you may not know this, but the majority of mortgages written in this country ultimately get sold to these big pots, these big pools. These pools buy up a bunch of mortgages and then issue bonds against it. Gets a little complicated, but basically, your mortgage rate or our mortgage rates collectively are as low as they are, largely because there's this big facilitation machine behind the scenes that buys up mortgages, packages them, and sells them off as bonds to people who want to buy them. Those are called mortgage-backed securities. They're bonds that are backed by loans on principal, residential residences. And we should ask about bond funds. Yeah, I'll get to that at the end. At a very high level, a bond fund is just simply, it's a mutual fund that instead of like a stock mutual fund that owns a bunch of stocks, it's a fund that owns a bunch of bonds. I'll elaborate as we move on, and we should, but good question though. Another interesting fact, and this could get complicated quickly, but the price of a stock could in theory be anything. It can go to zero, which would basically only be if the company disappears. So whether it's bankruptcy or it ends up they're fraudulent and a complete sham, and the stock collapses to zero. That's one extreme. It can't go below zero. You can't lose more than you put in, but a stock can go to zero. Or it can in theory, go infinitely high. Um, Now, it can't actually be infinity because that would imply the company's worth more than the largest number you can possibly think of, which isn't possible. But, there's nothing stopping Tesla from being $500 or whatever, which seems outrageous. It used to be 100, then 200, 300. It can keep going. There's no sort of, there's no really confining factors to the stock that say, no, this just possibly can't be worth more than X. It could ultimately be whatever, all said and done. Bonds are different. With bonds, because with a stock, you have equity ownership. And that's what makes stocks so impossible to value and almost pointless to try, in my opinion. How do you value your slice in a company like Apple? You're going to seriously tell me you can practically put like a rational number on what Apple is worth? Good luck. There's people who make careers out of trying to do that, and they're often proved wrong. With a bond, you don't own this theoretical, big, abstract company. Your value is purely the cash flows you're going to get from the bond, which are, pop quiz, your interest payments and your repayment of principal at the end. That's it. There's no more possible upside to your bond. So the value of your bond can never exceed the simple sum of all of your future interest payments you are due to receive and your future principal repayment you're due to receive. So let's look at an extreme. You bought a bond 10 years ago that matures in 10 years. Fast forward to today. We are 1 day away from that bond's $100 tomorrow when your bond matures. How much is that bond going to be worth today? It's not going to vary very much from $100 because why would it? Why would anyone pay $150 when all they're going to get at most is $100 tomorrow, right? And same thing on the other way. There's no way someone's going to pay $50 for it only when tomorrow I'm getting $100 for it. So point is, there's a lot more science and rational bounds to the price of bonds, which will make more sense later when I say why bond prices are stable relative to stocks. They're not going to whip around up and down 10, 20, 30, 40%, day to day, month to month, year to year, because their price is bound by the cash flows they're going to eventually produce for whoever owns that bond. Whereas a stock, again, it's a super abstract. Let me try to value what it's really worth to own a slice of Apple. Good luck with that. That's impossible, or as close to impossible as you can get. Okay, that was a bit of a rant about stock and bond prices. So, all right, a few questions here. So some of you seem to be fairly advanced in your bond knowledge. So Brenda's asking secured or unsecured. Great question. More technical than I thought people would ask, but secured or remember, I think I started to say this. Oh yeah. So when you own stock, you own equity in a company. You have an ownership stake in the company. You get what's that actually worth if the company goes bust and they have to pay out all of the people they owe money to, receive money from everyone that owes them money. They basically settle up the bill. Whatever's left, that's what gets divvied out to the equity owners, the stock owners, if anything's left. In the case of like Enron, Lehman Brothers, whatever, I don't think there's much left. Well, there was some, but not a lot. So effectively zero left over because they were insolvent. They owed more than they owned. So you do the math. Once you pay out everything you owe, there's nothing left. So equity owners get stiffed. Bonds are structurally senior. When you're a bondholder, when you're a debtor, as opposed to an equity owner, you get paid out first. So if and when that company goes bankrupt, they first pay off like their trade vendors that they bought materials from. I think then the next, there's like a 14-step order. I forget the whole thing. Next is like employees get paid deferred wages or whatever wages are owed for the week or for the 2 weeks. And then bondholders get paid their interest and principal. And then whatever's left, if anything, then the equity owners get paid out ultimately. So Brenda's question is secured or unsecured. So within that slice of payout structure for the bondholders, you can have multiple, and this is what makes bonds so complicated, you can have multiple layers of priority or seniority within bonds. You can have senior, super senior, junior, subordinated. So you can have like this bond gets paid out before this bond, which gets paid out before this bond, which gets paid out before this bond, whatever. Where I'm going with that is when Brenda's asking secured or unsecured, you can have bonds that are what's called secured, meaning they're backed by like some sort of collateral, whether it's like some big aluminum stamping machine or something. Like if the company had to, they would sell off that which is securing your bond, take those proceeds, and pay you off. An unsecured bond doesn't have any collateral or anything directly attached to it. It's just a general obligation from the company that says, yes, take our word for it, we'll pay you. We're not earmarking any particular assets or funds. We're just saying we'll pay you. That's unsecured. Whereas secured is there is something of value directly attached to that bond that could be used, could be liquidated to pay that bond off if and when it had to. Good question, Brenda. Dan adding a comment, I guess, GNMA, so that stands for Government National Mortgage Association. That's a federal agency that I mentioned before, pools up these home loans, sells them off into individual bond slices, and he's saying bonds are an IOU. Yeah, bonds are nothing more than a loan. And we should ask, why does it vary at all? I guess that's price. Why does price vary at all? Yeah, hold on. That's in the next segment, which also ties into Scott's question. What's the risk of default for corporate and muni bonds? So before I get into that, I want to, coincidentally, great segue, you two. What are the risks involved in bonds? Well, first is default risk. That's simply that the issuer of the bond will not be able to pay you in full and on time for all the payments it's supposed to make. Again, those are the interest payments every 6 months, let's assume, and then the principal payment at the end. If the bondholder if the borrower slash company at any point pays you late or doesn't pay you at all or doesn't pay you in full, that's a default. That's default risk. Corporations obviously have default risk. You know, a company can go bust or could get blown over by a massive hurricane and their operations cease and therefore they don't have the money to pay you. That's a default. So you face that risk with almost every bond. You know, the risk that the organization behind it may not be able to pay you in full and on time. With United States Treasury Bonds, they are considered to be default risk free, which isn't entirely accurate. There was a point, I forget when, there's a couple points in US history where they were actually technically delayed on making interest payments, which is a default, formally a default. Now it was cured and fixed within a few days. You know what happens when there's a looming government shutdown. You know, there's an impasse about a budget. They can't agree on a budget. If they can't agree on a budget, they can't agree on the monies necessary to appropriate the monies to pay interest. Then they simply can't pay the interest. So it often becomes like a political fight. There'll be a head-to-head match between one party and the other about approving a budget. And they'll say, hey, if we don't approve this, we're going to default on our bonds because we need this budget approved by midnight today so we can pay all these bonds interest tomorrow. At some point in history, anyway, there was an impasse, the budget wasn't approved, and the U.S. defaulted for a couple of days on paying its interest payments, but then the budget was subsequently approved, and the interest was paid, and everything was good. So technically, U.S. issued government debt can default, but practically speaking, if they do default, it's going to be like, oops, you're delayed today. It's not going to be like, hey, we're out of money, we got nothing to give you, and sorry, bondholder. It won't be that bad. So anyway, point is, U.S. government bonds are assumed to be default free, that the government will never default. And then there's interest rate risk. And this gets to your question, Anwisha. So when you have, let's say you bought a bond last year and it paid you bought it for $100, so you'll get $100 back at the end, and it had a coupon payment of, let's say, 2% per year. So every 6 months you get 1%. So you know you're getting 1% twice a year. So you're getting 2% coupon, 2% interest each year. That may have sounded great at the time, right? But now, fast forward to today, rates have dropped a lot since the pandemic and economic mess and whatever. So bonds of that sort today, if someone were to issue a bond like that today, they would only have a 1% coupon, let's say, instead of a 2%. So now, the bond you bought last year is much more valuable than a comparable bond someone could buy today because your bond pays a 2% coupon, you know, $2 coupon, let's say. A comparable bond today would only pay a $1 coupon. So why, you know, if someone could buy that bond today for $100, how much you think they're going to offer to pay for your bond instead? where they can get $2 instead of $1 every year. They're going to pay something more than $100. So that bond you bought for $100 last year will now sell for more than $100 if you were to sell it to someone, because it has a higher coupon payment, higher interest payment than what someone could get today. So in Wisha, that's why bond prices would move. You bought it for 100, interest rates have since dropped, your bond became comparatively more valuable. So if you were to sell it, you would get more than $100 for it. That's why bond prices change. Good thing to know, mathematical rule of thumb, when interest rates go down, bond prices go up for that reason I just walked through to Anwisha. And then the opposite holds true. When interest rates go up, bond prices go down. So let's look at that previous example, but from the flip side. So a year ago, you bought a bond that had a 2% coupon, 2% interest payment. Let's assume now interest rates have risen since then. So you can get a comparable bond today for $100 that now pays 3% interest. If I try to sell my bond I bought last year that only has 2% interest, no one's going to give me $100 for it because they can pay $100 today to get a 3% bond. So in order to make my bond sale enticing to someone, I'm going to have to sell it for like $95, let's say, something less. And that's why bond prices would drop. So hopefully that answers your question, Anisha, of why bond prices move at all. It's basically because of interest rates. And that's interest rate risk. That was the point I was talking about here. As interest rates rise and fall, bond prices will fall and rise. Because again, prices move opposite to interest rates. Rates go up, prices go down, rates go down, prices go up. That's interest rate risk. Now this gets technical, but I won't explain why unless anyone's interested in asking me after, because this could be a whole lecture in and of itself. Bonds that have longer maturities, their prices are more sensitive to changes in interest rates than bonds with shorter maturities. So if you have a bond with 30 years left and interest rates rise, that bond price is going to drop more than a bond with only 1 year left. Let's leave it at that. There's very good bond math reasons why that holds true. It's beyond the scope of today, but just know that the longer the maturity of the bond, the more price risk and price whipping around you're going to have, as opposed to a shorter maturity bond. And then the next big risk, there's more risks than this, but these are the big ones. The next one is what's called liquidity risk. Remember I said stocks trade on an exchange. You can easily and quickly go buy and sell a stock within a fraction of a second. And there's not going to be big price movement for whether you buy or sell now or in a minute from now. There's lots of people out there willing to buy and sell. The market's very efficient. So you can buy and sell at more or less the same price to anyone at any time when you're buying stocks. Bonds are different because bonds don't trade on an exchange. Because there's not as many participants buying and selling, there's generally less demand for any given bond. So there's what's called liquidity risk. You may have bought a bond for 100. You now turn around 5 minutes later and want to sell it. You may not get $100. You may only get $99 or $98, simply because there's less people, there's less market participants, less demand pressure, that there's going to need to be this sort of gap in price from where you buy and when you sell, just because there's less people trading it. So I'll leave it at that. But point is, buying and selling stocks is a painless, pretty seamless. You can do it often without a lot of risk of price changes from you buying and selling. Bonds are a different story. It's called the bid-ask spread for those of you who are interested or work in the industry. Bid is the price you buy, ask is the price you sell. With bonds, there's always going to be some sort of decently sized difference in the buying price and the selling price. Okay, let me stop there briefly. I see questions flowing in furiously. Oh, so Scott, I didn't address your question. What's the risk of default for corporate immunity bonds? Muni means municipal bonds. It all depends. So there are independent rating agencies like Standard & Poor's, Moody's, and Fitch are the big ones in the US. And there's a rating scale from AAA all the way down to D, which stands for default. And then there's various steps and levels in between. So those rating agencies try to independently and objectively rate the credit worthiness, the credit quality of bonds and bond issuers. So it's possible you can have a super highly rated company like like Microsoft, who doesn't have much debt, but they do have some bonds outstanding. I forget, I don't know what their rating is, but it's super high. Um, that is going to be a much safer bond than buying a bond from some fly-by-night small startup company who doesn't have a good chance of surviving to the end of the year. Uh, so you can't generically say all corporate bonds have the same risk. They're all high or they're all low, because it's not. It's really all over the map. Super strong, super well-rated companies with exceptionally low default risk. And then there's just garbage at the bottom where there's a better chance they'll default than not. Sort of same thing with municipal bonds, Scott. As a whole, I can't say that. So some municipalities are quite strong, others are quite strained. Like state of New Jersey, where I live, for example, not in a great spot. State of Illinois, not in a great spot. I don't know of other states that are doing exceptionally well. I'm sure there are some. But the point is, even within munis, there's some really well-rated, strong credit quality towns or states, and then there's some that are really struggling, and then everywhere in between. So you can't say all corporates are better than all munis or vice versa, because it really all depends on the individual issuer. But good question though, Scott. All right, David asked, why is the bond market so much larger than the stock market? There's just more of it. Like from a retail individual perspective, you don't see this. But when you work in the institutional banking and finance world, you realize debt makes the world go round. For better or worse, we're in a capitalist society. Debt is what makes things work. Debt isn't necessarily bad if used properly. It's when debt's abused that it becomes a problem. But debt makes capitalism work. Write that on a t-shirt. And there's so many forms of debt. Governments, the U.S. Treasury, I don't even know how many trillions of dollars of debt the United States has. Those are bonds. So right there's a few $1 trillion of U.S. Treasury bonds. The U.S. mortgage market is all possible thanks to debt, thanks to bonds. You get your mortgage at such a low rate because there's this bond-making machine behind it that's Dan mentioned, Ginnie Mae, the Government National Mortgage Association, and Fannie Mae, Freddie Mac. There's other agencies whose job, their mandate, is to buy up mortgages, pool them up, sell it off in bonds. That process of pooling up, buying mortgages, it provides liquidity to the mortgage market to make home ownership possible. Home ownership has always been a cornerstone of the American dream. That's all made possible thanks to bonds and debt that you don't see as a borrower. But when you work in the institutional side, you see, damn, there's trillions of dollars of mortgage debt, mortgage bonds that make all of us getting a mortgage possible. So you have government borrowing, you have mortgage borrowing, you have corporations. Again, everyone sees and knows stock, but they don't see and know all the corporate debt there is floating around out there. So you got the corporate bonds. You got municipal bonds. How do you think towns pay for? They raise tax, obviously, but towns they issue municipal bonds to pay for things. Stadiums are built by way of municipal bonds. Water treatment plants, municipal bonds, etc. So I wish I prepared exact figures. I didn't, but David, that's why. You don't realize it, but there's so much debt in this world that makes the world tick, for better or worse. All right, Dan, in the current environment, what's my take on state muni bonds, and would bond funds within a single state be enough diversity? I frankly don't know enough about municipal bonds. That's a specialty in and of itself, Dan. I mean, I know what they are at a high level, but unless you actively follow each state and your job is a full-time municipal bond analyst or manager, I simply don't know enough about that, Dan. Good question, though. All right. Okay. Okay. What else we got here? So comments, good, thank you. David Fultz, bond duration. Yeah, I said I wasn't going to go there. I'll try not to. So I mentioned before, David, that the inverse relationship between interest rates and prices. As interest rates fall, bond prices rise, and vice versa. Interest rates rise, bond prices fall. There's a mathematical formula behind that to figure out how much. Duration is the quantified measure that actually pinpoints for a given change in interest rates, how much percentage change in price will this bond have. That's duration. If you really want to know, I mean, I assume you may want to know because you asked, if a bond has a duration of 5, that means for a 100 basis point change in interest rates, or meaning a 1% change in interest rates, that bond price will change by 5%. Got that? So duration of 5 means a 100 basis point change in interest rates means the bond price will change by 5%. That's duration, David Foltz. I'll leave it there. When I taught the class, we spent multiple hours of lecture time actually detailing and calculating duration and the formula behind it. But just know that's the measure of how sensitive a bond's price is to a given change in interest rates. That's duration. All right. Man, Dan's asking some meaty ones here. Can you comment on the equity correlation of corporate bonds versus Treasury government bonds? I can't, David. I know why you're asking, but I don't have the detail, the data in front of me to actually say what the correlation is. But I think I know where you're going with this. Generally speaking, if the economy weakens, companies weaken, corporate bonds weaken, stocks also weaken. Now, stocks will generally weaken more than corporate bonds will, again, because bond prices are bound by an upper and lower range. The upper range is simply the sum of all the future payments. The lower range is 0, but practically it's always going to be something more than 0. I don't know of any bonds where the company default and truly paid out nothing. So, but anyway, bonds price will be like this. Equity price will be like, so yes, bonds and corporate equities are correlated, but equities are whip around more. And government bonds, yes, I don't have the data to back this up, but I tend to say they're usually inversely or negatively correlated, David, meaning they're a flight to quality. So when the markets get nasty, when economic turmoil hits, risky assets like stocks drop. Somewhat risky assets like corporate bonds drop somewhat. Everybody runs out of those and runs to safety. They dump all their money in treasuries. So that usually makes treasury prices rise. So therefore, treasuries are usually negatively correlated to risky assets like stock and corporate bonds. Jay asked, junk bonds, question mark. Yeah, those are just simply bonds that are below a certain rating. I mentioned before, Standard & Poor's, Moody's, and Fitch independently rate bonds. Junk bonds just mean anything in the lower half of that rating spectrum, basically. Doesn't necessarily mean they're junk. Junk's a bit of a misnomer. It does mean they're lower quality than those that are higher quality, but they're not necessarily junk. Junk's a very subjective term. All right. Yeah, so David just chiming in, exactly, yeah, about debt. Think about the size of the mortgage markets. Good. Cannon adding some global macroeconomic color about Asian and African countries issuing debt. Yes. Okay, David loves Ginnie Mae bonds. All right, let me, fantastic questions. Let me keep chugging along here to make sure I hit on the stuff I want to hit on. So taxation of bonds. I'll try to keep this simple. Municipal bonds. This is one of the big points, selling features of municipal bonds. The interest they pay, the coupons they pay, is federally tax-free in almost all cases. There are some exceptions, but most municipal bonds, you do not pay federal income tax on the coupon payments, interest payments you receive. Capital gains could be different. If you buy a municipal bond at 90 and you sell it for 100, that $10 gain will be taxed like any other capital gain, either short-term or long-term, but the interest payments are usually federally tax-free. If it's a municipal bond issued by the state you live in, then you almost always won't pay state tax on that interest either. If you own a municipal bond from outside your state, so I live in New Jersey, if I bought a Illinois municipal bond, I would not pay federal tax on the interest. I would pay New Jersey state income tax on that interest. But New Jersey municipal bond, I would not pay New Jersey income tax on the interest. So that's municipal bonds. U.S. Treasury bonds, the interest is taxable federally, not taxable at the state level. I can't speak for all states, but I think that's the case for most, if not all states. And corporate bonds are fully taxable across the spectrum. Interest is taxable federally, taxable at the state level, and interest is taxable as ordinary income. There's no special like long-term capital gains rates. It's just normal income to you. Again, capital gains are different. If you buy low and sell it high, then the gain could either be short-term or long-term, depending how long you held it. But it's the interest that gets special treatment. The capital gains are no special treatment. And that's all within a regular taxable brokerage account. If you own this stuff inside an IRA or a Roth, where there are no tax implications of what happens inside the account, it doesn't matter. Whether it's interest or gains, like in an IRA, for example, it's all taxed at regular income tax just the same. When you eventually take the money out, doesn't matter what buying or selling or interest or dividends or gains happen inside the account, doesn't matter. You're only taxed the same when you take it out, which is why, remember back a few months ago when I talked about the asset location ditty, you generally don't want to hold municipal bonds in a tax-deferred account like an IRA, because the interest on municipal bonds is tax-free if you hold it in a regular brokerage account. If you instead own that municipal bond in an IRA, you're now subjecting all those interest payments to regular ordinary income tax when you eventually take that money out. So it's usually a big no-no to put municipal bonds in a tax-deferred account like a traditional IRA or 401k. All right, next topic here, managing, and I'll get the bond funds. I swear they make this whole thing much easier, and I use bond funds myself. But managing the risk of bonds. So let's go through the risks I mentioned before: default risk, interest rate risk, liquidity risk. So default risk, as I mentioned before, if you own U.S. Treasuries, they're inherently kind of default risk-free, so there's no default there. But when you start investing in corporate bonds, municipal bonds, you start introducing the potential for the issuer to eventually default or go away, or not make good on their promise to repay you. How do you deal with that? Well, a few ways, and we've sort of touched on this. There are independent agencies that rate these bonds, so if you're that concerned about default risk, you stick to the higher rated ones, the better quality ones. Now the downside is there's no free lunch. There's this risk-return spectrum. If you're going to invest in a lower risk asset, you're not going to get paid very much. Your interest payment's going to be small. So if you're really desperate for yield, you're desperate for some interest, you're going to have to start going down the credit quality scale and start investing in some lower grade, potentially, dare I say, junk bonds, as Jay pointed out, the name junk bonds. But then you start running a higher risk of that company eventually defaulting. That's why they're paying more, because they're riskier. So anyway, so you can minimize default risk by only sticking to higher quality issuers to start with, or diversify. Same concept to stocks. You own one stock, it's great until that stock disappears because they're fraudulent or go bankrupt. Bonds are the same thing. So how do you prevent against one position going sour and blowing up your whole thing? Diversify, invest in multiple bonds. Now this is where bond funds come into play. It's not really practical for you, a retail investor, to be buying and selling a bunch of individual bonds. You can, but it'll be relatively expensive because, again, bonds don't trade on a nice, pretty exchange. You're gonna have to call up a broker or something. You're gonna pay a decent commission, trading charge per trade, and there's a liquidity risk because most bonds aren't bought and sold as much as stocks. You may, like I said, buy something at 100, turn around and sell it 2 minutes later. You're only going to get $95, $96, $97, whatever, because there's not as active as a market for bonds, at least in the retail investor space. Institutionally, it's a bit different, but you're not going to get institutional pricing. I guarantee you that, unless you got multi-million bucks and you're some high net worth platform. But if you got $1,000, you want to go buy an individual General Electric bond. That's a bad example. GE's not doing well. Whatever, Microsoft bond at your broker. It's not going to be cheap for you to do that. So anyway, so that's sort of the downside of trying to manage your own bond portfolio by buying a bunch of individual bonds. It's going to be expensive. It's going to be a lot of work. Just get a bond fund. Hold that thought. I'll talk more about bond funds. And then interest rate risk, how do you manage that? As I mentioned before, remember, the longer maturity bonds have much more interest rate risk versus shorter maturity bonds. So now, for example, interest rates are historically low, darn near zero. There's not a lot more room for it to go until it actually hits zero and potentially goes through it to negative. Germany and Japan have had negative rates for years. We haven't gotten there yet, thankfully. But point is, when interest rates were 5-6%, there's a lot of room for them to collapse down to zero. Now, interest rates, depending on what rate you're talking about, is already inside of 1%. There's not that much more room for it to go, which means there's asymmetric risk. There's more risk that rates will rise, and rise by a lot, than they will drop by a lot. So that means, my opinion, generally speaking, is it would be kind of dangerous to have your bond exposure be mostly in long maturity bonds, because long maturity bonds have larger duration, David Fultz, which means if and when prices rise, bonds with long maturities, their prices will drop a lot more than bonds with shorter maturities. So how do you manage interest rate risk? Just exactly that. Don't necessarily play around with long maturity bonds, or if you have a few, fine, but you don't want the majority of your bond portfolio to be bonds with like 20 or 30-year maturities. That won't turn out well if we have massive inflation and rates rocket up. So you can use short-term bonds, which are like 1 to 3 year maturity, 1 to 5 year maybe, depending who you ask, or what's called intermediate maturity, which are things that are 5 to 10 years typically would be deemed intermediate term bonds. And again, this goes back to like just use a bond fund. Instead of you trying to monkey around picking and choosing individual bonds to make a portfolio, forget it. Just get a bond fund, which again, I'll touch on in a bit. So that's how to manage the risk of bonds. Let me go back to your questions here. I see there's a handful. Let me see if I can get caught up. Dave Giordano. So when interest rates increase, bond prices reduce, but yield increases. Yeah, and this is why retail folks don't play around with bonds, because it gets complicated and mathy real quick with having to think about yield and stuff like that. You don't have that concept in equities and stocks. So yes, David, you own a bond and interest rates rise, your bond price will drop. Will your yield increase? No, it depends when you sell it. When you bought the bond, there's something called yield to maturity. If you hold that bond to maturity, it honestly doesn't matter what happens to its price along the way. You're going to get paid out the principal at the end, $100. So your yield to maturity from the time you bought it to when that bond matures, your yield is locked in. That's called your yield to maturity, if you hold it to maturity. If you sell it along the way, you can throw your yield maturity out the door, because you're going to get whatever price you sold it for. So the original yield you thought you were going to get is going to be less if you end up selling it prematurely at a reduced price. But then if and when you go and reinvest, the new thing you reinvest in will be at that higher assumed yield, expected yield, Dave. Let me leave it there. Again, this can get really technical and mathy real quick, but I appreciate what you're asking and I understand it, but hopefully that explanation did some justice to it. All right. Julia, I logged on late. Did you discuss bond funds yet? No, sort of. Touched on it, but haven't really gotten to it in earnest. I will shortly. All right, yeah, sorry. So, yep, Alan told her coming up. Mavis, if you sell X company stock at a loss and then immediately buy X company's bond, can that be considered a wash sale? No, Mavis. Great question. Stocks and bonds are extremely fundamentally different, even if they are of the exact same issuer, would not be a wash sale. Now, here's where it gets hairy. And this goes back to Cannon's question. There's some bonds that are called convertible. It's a bond that has an attached stock option, meaning you can convert that bond into stock. You can say, I give up this bond, I don't want it, instead give me 100 shares of stock. That's a convertible bond. That would be a wash sale. So any bond that has some sort of equity component or equity option to it can trigger a wash sale, Mavis. But a pure, traditional, straight up bond and bond only, where it's only going to have interest payments and this principal repayment at the end, no, not a wash sale. It needs to be an equity or an equity replacement that would trigger a wash sale to you selling an equity. Mavis, good question. Oh yeah, Beth making sure I did not forget her question about devalued dollar. Right, so let's assume you bought a bond. Here's something that'll blow your mind, people. So bonds have a currency denomination because they have interest payments. So when you buy a bond, it'll contractually say these interest payments will be 100 US dollars every 6 months, and the principal payment will be 1,000 US dollars at the end of the bond. So Beth, if the dollar gets devalued, it really doesn't matter because your bond is purely in US dollars only. You're going to continue to receive US dollars just the same. Your life is paid for and financed and lived with US dollars. So practically speaking, not much would happen to your bond, assuming you held it to maturity, because you'll keep getting dollars. It's a different story if the dollar gets devalued and because of that, the dollar-based interest rates change. macroeconomics is a hairy, prickly thing, but and it's hard to explain and justify. But if U.S. interest rates change, the level of interest rates change, that will affect your bond price. So if you were to sell your bond prior to maturity, then yes, dollar devaluation will impact your bond because you may get more or less than $100 when you sell your bond. But if you hold your dollar-denominated bond to maturity, dollar devaluation basically doesn't matter, Beth. Now, if you owned a bond denominated in foreign currency, and there's many of them out there, so you own a bond that pays in euros, very different story. In that case, it would be good for you if you got a bond that paid you interest in euros and the dollar weakened. That means you can take your euros and now buy more dollars with it because the dollar weakened, and you can go buy more food and clothes and cars and whatever. Right. So I'll leave that one there about dollar. Hopefully that answered it, Beth. There's no single answer. It kind of all depends. But if you have a dollar-denominated bond, it won't really matter. Oh, and here's where I said what's going to blow your mind. So bonds have a contractual currency amount they have to pay. Stocks don't. There is no concept of stocks having a currency denomination. Now you're going to say, but wait, I bought this stock through E-Trade. It trades through the New York Stock Exchange. I paid dollars for it, and it pays me a dividend paid in dollars. Well, guess what? That's not a contractual requirement of the shares. It's just because you bought that through a U.S. dollar-denominated exchange that you get paid out in dollars. If you bought that same stock in Germany on the Frankfurt Exchange, you're getting paid out in euros. So stocks don't have a currency denomination. Took me a while to agree with that when I first heard it, 15 years ago, but they don't. Bonds do. Stocks don't have a currency denomination per se. Fun fact. Debbie Miller, what is a bond ladder? How is it different than bond funds? Yeah, great question. I guess good segue into bond funds. So, hold on. I'm parched. A bond ladder is you buying bonds with staged, staggered maturities. So today, you buy one bond that matures in a year. You buy another bond that matures in 2 years. Another one that matures in 3 years, 4 years, 5 years. So now every year, you get this known cash flow. You're going to get interest along the way. And then in 1 year, you're getting the principal repayment from that first bond. The next year, you're getting the principal repayment from your second bond. Da-da-da-da-da-da-da. That's a ladder. If you picture it, you have different rungs. Each rung is a year or every 6 months or whatever. So bond ladder is using a collection of individual bonds to pre-set up specific payout or repayment dates for yourself. A bond fund, segue time, is this evergreen ongoing thing. And like I mentioned before, just like a stock fund is nothing more than a pooled collection of a bunch of individual stocks, a bond fund is nothing more than a pooled collection of a bunch of individual bonds. It's that simple. Here's where it gets weird. Stocks, as I said, don't have an end date. Stocks live on forever until the company goes bust or decides to close its door, or it gets bought out by someone else and that stock gets folded into the acquirer and disappears. Otherwise, stocks live on forever. Bonds don't. Bonds have maturities. Again, 1 year, 5 years, 10 years, 30 years, whatever. So when you have a bond fund, the bonds in that fund today are what they are, but fast forward 5 years from now, the bonds will be different because there will be some bonds that will have inevitably matured out and have to get replaced by another 5-year bond, which in 5 years matures, so then you have to buy another 5-year bond. So there's always going to be some coming and going of positions within a bond fund because bonds mature and eventually go away. Where was I going with that? Okay, so that's bond fund at a high level. Let me start talking about them more now. So Julie, you asked about bond funds. Here we go. You can have, just like you can have stock funds of all sorts of kinds, U.S. stock, international stock, small company stock, large company stock, technology only stock, healthcare only stock, dividend only stock, you name it. There's ridiculously too many amounts of investments out there. I'm sure you all realize. And a lot of it's just people trying to sell stuff, companies trying to sell stuff. There's probably, I'm making this up, there's probably, 1,000 different large cap US stock funds out there, right? That's insane. Now, go capitalism, yay, nothing's going to stop a fund company from coming up with their version. They think the latest and greatest US large cap stock fund, doesn't matter, right? It's ridiculous how many funds there are that all effectively do the same thing. I'm getting on a rant. I'm not sure where I'm going with that. But anyway, so point was, you can have all sorts of stock funds sliced and diced and specialized however you want. You can do the same with bonds. And bond fund managers do this intentionally to try to sell and fill a need or create a need to sell a product. You can have funds that are, and June asked about this in a post before, so here we go. You can have bond funds that are just United States Treasury bonds. Within that, you can further bifurcate it, trifurcate it, whatever. You can have just long-term U.S. Treasury bonds, those with maturities greater than 20 years. You can have just short-term, those with maturities less than a year. You can have intermediate term, those with average maturities of like 5 to 10 years. You can have corporate bonds that are just U.S., just international, just high credit quality, just low credit quality, just a certain sector. Sky's the limit with what fund managers can concoct and sell and market to the world. I saw a handful of posts here about inflation bonds or TIPS. TIP stands for Treasury Inflation Protected Security. These are a special type of U.S. Treasury bond where the basically as inflation goes up, you'll get paid more. So whereas normal bonds, and this helps counteract some of that interest rate risk we talked about. Remember, if rates with normal bonds that have a fixed interest payment and a fixed principal repayment, if and when interest rates rise, those bonds drop in value. The Treasury's solution to fill that gap, if you will, is Treasury Inflation Protected Securities, otherwise known as TIPS, or just Inflation Protected Securities. These are Treasury bonds that if and when interest rises, the amount you get paid will rise with it. So that'll help compensate and offset some of the loss you'd otherwise experience in bond price when interest rates rise. That's a TIPS. That's a Treasury Inflation Protected Security, or I bonds. I see Alan saying, inflation bond. What's my thoughts on them? Yeah, I get it. I know what they're there for. I think it's more complicated than the typical person/retiree needs. And here's why I say that. If for whatever reason the entirety of your portfolio was just bonds and it was just like fixed rate traditional bonds, yes, inflation is a big problem. In that case, it would make sense to consider some inflation protection by way of TIPS, Alan, or I bonds, Alan. But I can't think of a good reason why anyone would have a purely bond portfolio. There's a reason why people say the 60-40 stock to bond portfolio is the Swiss Army knife of portfolios. And it doesn't need to be 60-40, whatever. It's 70-30, 50-50, whatever. Point is, you always should have some equity, some stock exposure. If and when inflation rises, stocks generally do better. So yes, your bonds will lose some in value, but your stocks should make up for it. And that's the whole reason why you have a stock and a bond portion of your portfolio. They do different things at different times for different reasons. So my answer to you, Alan, is a simple, well-constructed, don't make it more complicated than it needs to be portfolio of, let's just say, 60% stocks, 40% bonds. When there's inflation, your stock should do well for you. So I don't think you need to get as fancy as trying to figure out, should I get inflation protected bonds, and if so, how much? Stocks are your inflation protection. Pure academics may not agree with me there, but practically speaking, I'm confident in saying that that's a valid approach to deal with inflation. Good question though. And talking about, so I forgot to bring these up. I did make some slides just to sort of show how bonds and stocks, what their roles and expectations are in a portfolio. And I'm saying bonds and stocks, but I'm assuming, this can mean bond funds, stock funds. It basically means a collection of stocks and bonds. So these aren't to scale, but this is what my financial planning software created. So I said, assume you have a $1 million portfolio that's all in stocks. I won't name the names because I don't do that on my show, but this is a very well-known stock mutual fund that basically covers the entire U.S. stock market. So you have $1 million today. This is projecting out to 2055. It's running 1,000 simulations of how good or how bad could markets realistically be in the future, and let's see what that portfolio value may end up at in 2055. The low point of your $1 million today would be, let's call that 15 million bucks right here. The potential high point would be, where are we at? That's almost $80 million. And then everywhere in between. So this software ran 1,000 simulations of what may potentially happen and plotted out all the outcomes. So there's your low, there's your high, and this is sort of like your median, which is, what is that? We'll call that, I don't know, 30 million bucks thereabouts. So this is a pure stock portfolio, lots of potential outcomes because, no surprise, stocks can have a lot of whipping around. What if you had a bond-only portfolio? Same thing, $1 million bucks. I won't name names, but this is a very large, well-known bond-only fund that invests roughly half in U.S. Treasuries and half in investment-grade U.S. corporates. Start with $1 million bucks. Again, this isn't scale to last time, apologies. But 2055, this $1 million bond portfolio, best case is it ends up at, what is that? I don't know, a little over $4 million bucks. Worst case, it ends up at about 3. The middle is, whatever that is, I don't know, close to 4. So drastically different story than all stock. What happens if you combine those two together? I did 50-50. So same thing, start with $1 million bucks, but now I took half of that stock fund, half of the bond fund. Let's look at the forward projections. 2055 now, this combined portfolio. The low scenario is, we'll call it 8 million bucks. The high is, I'm upside down, I'll call it 18 million with the median of, let's call it 12. So you can see the impact that bonds have on an all stock portfolio. It brings it down, and for good reason. Now you may say, hey, wait, 35 years, why wouldn't I want that all stock exposure? If you never need to touch this money ever, then yes, this makes sense. But practically speaking, chances are you're going to need to, right? Life happens, expenses happen, health issues happen in retirement. Children need support. You give them money or whatever. You're going to need to spend money most likely in retirement. This gets into sequence of return risk. I won't get too far into this. We discussed this in other topics. Along the way, yes, long-term stocks should do better than bonds should over decades. But along the way, stocks can go, look at what happened in March. Stocks dropped 30% in the course of like a month and a half. That was scary. I'm not going to lie. I didn't like that. But they came back. Long-term stocks should do good. Short-term stocks could be nasty as heck. So bonds provide a counterbalance. David Fultz, I did not come up with a ship graphic, but I did do something I thought was a little less hokey, more hopefully meaningful. 60-40 bond portfolio, $1 million bucks. You have 600 grand in stocks. Let's assume it's this, large U.S. stock fund. You have 40% or 400 grand in bonds, right? You start out, this is your starting allocation, you're entering retirement. Let's go, see what happens. What if, and let's assume you need to spend from this. I'm not sure how much, but you need to pull money regularly each year. What if you have a really good stock market? Your 600 grand in stocks grows to 700 grand. Good. So you need to spend money. You're going to take it from here, right? You're going to spend this. This is the house money at this point. Or if you don't need money, you would rebalance. You sell some of your stocks to add to your bonds to bring your 60-40 proportions back in line. Otherwise, if you let your stocks keep going, you're going to end up at 70-30, 80-20, whatever. So you would either sell your gains from your stock. Let me get this back in camera. Sell your gains to replenish and add to your bonds, or if you need to pull income, you pull from your gains here. That's a good stock market. What if you have a bad stock market? I should get a good color printer for this stuff. Bad stock market. Same thing. You're starting with a portfolio that was 600 grand in stocks, 400 grand in bonds. That's your 60-40. Stocks don't do well. You lose 100 grand. Your stocks drop to $500,000. You need to pull money for living expenses. What do? You do not pull from your stocks. They're depressed and beaten down. You take them out when they're low. You're now taking away the ability for them to rebound. You instead, this is what your bonds are for. This is your ballast. This is your relatively safe and stable. Now, to be fair, Your bonds won't necessarily stay at exactly 400 grand. Could be a little higher, a little lower, but the point is your bonds will not whip around like your stocks are going to whip around. This is your balance. This is your relative sea of safety and security. So in this scenario, stocks drop. You need money. You take from your bonds. You do not deplete this when it's depressed, which is the opposite of this. Stocks do well. Yeah, you use that money. Take advantage of it. That's your spending money if you need it. Or like I said, you don't need it. You sell some of your stocks. You buy bonds to keep your 60-40 proportions in line. Anyway, so your stocks drop. You need money. You take from bonds. By taking from bonds, your stocks went down. Your bonds now go down a little bit. That brings you back into your 60-40. And then eventually over time, the expectation is, whether it's 2 months or 2 years or whatever, your stocks should hopefully rebound and recoup themselves, so that when they do, then you start again, taking out your gains when they eventually happen. Makes sense? David Fultz, hopefully you approve of that choice of graphic usage. All right. So another quick comment about bond funds. So can you, an individual investor, use individual bonds? Sure. Do I recommend it? Probably not. Treasury bonds are relatively easy and efficient enough to buy and sell. You can buy direct from Treasury. There's something called treasurydirect.gov. You can literally buy bonds straight from the U.S. Treasury. Buying corporate bonds, buying municipal bonds, very different story. To buy those individually, you got to go through a broker. It's going to be expensive, relatively speaking. And it's going to be hard to manage and do the necessary credit analysis of each individual issuer yourself. Unless you want to make that a full-time job, I say don't bother. That's what bond funds are for. Delegate the process of creating a portfolio of bonds to professional fund managers who do it for you. They take care of the diversity. They get institutional pricing because they're buying and selling thousands of bonds day in, day out. Much more efficient for the average individual investor to invest through bond funds than it is individual bonds. What bond fund is right? I can't give you that advice over a Facebook Live. It's like saying what stock fund is right. It all depends. It depends how much interest rate risk you're willing and able to take. It depends if you have a personal feeling that this industry of bond issuers is going to do better than this industry or sector. Me personally, I keep it simple. I generally invest in a bond fund that's one part U.S. Treasuries, generally intermediate term. Again, I'm afraid of the longer term stuff because I think the risk is asymmetric, that rates will rise a lot as opposed to drop a lot. So I invest in the intermediate term maturity bonds, so a mix of treasuries and investment grade corporates. I personally don't play around with the lower quality, what's called high yield or junk bonds. That starts to get too risky for me. I instead, my risk exposure is the stock portion of the portfolio. The bonds to me is supposed to be that relatively safe, relatively stable. Maybe it'll go down a little bit if and when interest rates rise, but it'll throw off some interest payments, hopefully eke out a few percent per year. But you don't invest in bonds to kill it and make big gains. Bonds are your counterbalance to your equities. Bonds are your relatively safe, relatively stable. That's their purpose, in my opinion. There are professional fund managers who make a business out of investing in the craziest, wackiest, riskiest bonds you can find. And they work really well until they don't, until the economy throws up, then those bonds don't do so hot. Okay, other comments and questions. Dan says munis are TERP approved. If used properly, Dan, yes, they are. And if selected properly, because there are some states and municipalities that are struggling. Again, I don't personally traffic in trying to pick individual muni bonds. That's not my game. But I do know people who do, and it's its own specialized segment of the bond world is municipal bond investing. There's not a lot of people out there who do it, honestly. All right, so Dan asked a question about ballast. Yeah, I went through that. So Dan asked, what's my view on bonds as a ballast for capital preservation? Not so attractive with the yields today. Correct. Bond rates, bond yields are jokingly low. So unfortunately, you don't buy bonds today to throw off a lot of income because they're simply not. You'll get 1%, maybe 2%. Anything with more than a 2% coupon, you start to dip into some noteworthy default risk, Dan. So for me, bonds are just simply the ballast. The hope is they'll stay stable. The bonds I invest in, I'm not investing in really long-term or really risky stuff. They'll stay relatively stable, hopefully squeak out a few percent per year. On the upside, on the downside, maybe lose a little bit, not too much, but the point is just safe and stable. I'm not investing in those to try to make a killing. It's just hopefully make a little and not lose too much if and when they do lose, and just really just counteract and act as an offset and a hedge to the stock portfolio, which is the growth engine, the long-term growth engine. Scott asking about negative interest. Let me just see what other, so we're after 9. Let me see my other questions here. Yeah, okay. So I touched on everything I wanted to touch on. Everyone feel free to blast me with whatever questions you have at this point. Scott, negative interest rates are an interesting topic. If not today, could you give us your thoughts on those in a future session? Why would anyone buy Treasury bonds from Europe with a negative return when they can buy from other countries? Yeah, that's a good one. And here's the answer. And here's what I think the answer is. Stick with me, Scott. So, because there's no better option, because that's the price you pay for safety and stability. If you, and this is mainly for like large institutional investors, retail investors, I don't have a good case why they would knowingly pay zero, pay negative interest on something. But large institutional investors that have hundreds of millions of dollars of cash that they need to do something with, think about like a pension fund or a monstrously large mutual fund, they are mandated per their investment guidelines, required to have at least a certain amount of cash on hand. They need to do something with it. You can't literally keep $300 million of cash under your pillow like you and I could with our whatever, a couple $1,000 of cash. Yeah, if your house burns down, you're screwed. But for the most part, it's not that dangerous to keep a few $1,000 of cash in your house. You can't keep a few $100 million in a house, right? So if you're an institutional investor, you have to put cash somewhere. And when and that cash needs to be safe and stable, again, because your investment guidelines mandate it. You can't put it in stock. You can't put it in bonds that have risk of default. You have to put it somewhere safe and stable. If your only option are short-term Treasury bonds or bank accounts yielding negative interest, you have to do it. There's nowhere else you can put it, Scott. That's probably the best reason there is for institutional investors, which is the lion's share of what drives interest rates. You and I don't, retail investors don't drive macroeconomic things like interest rates. Big institutional money does. Hopefully that answered your question sufficiently, Scott. Cody's saying there are also bond ladder, structured bond funds. You name it, they have it. Yeah, exactly. Good and bad, right? So that's the upside of capitalism. Nothing's stopping anybody from coming up with the latest and greatest bond fund, mutual fund, ladder fund. You name it, it's out there. It makes it redonkulously confusing for the average investor to figure out what should I invest in. And it's such a disservice. I truly feel, I invest personally and on behalf of clients, super simple portfolios, less than 5 exchange traded funds, get the job done very well. Now, if you're high net worth or you have super crazy tax needs where like you need boatloads of municipal bonds to save yourself on taxes in the after-tax world, that's a different story. But for the vast majority of normal people, normal investors, a basic 3 to 5 fund portfolio is all you need. Stop at that. Don't complicate it. Even though the ads on, and don't read Forbes, don't look at the ads on CNBC. They're just all out to sell you the latest and greatest. All right, what else we got here? June Lee, currently the yield of a TIPS bond fund is negative. What does that mean? Should we have some money in it regardless for diversification? Let me wrap my head around that, June. I was not aware of that the yields are negative. So think about it this way, maybe. Here's my best guess. I think this may be right. When you buy a bond, a fixed interest bond, 1% coupon bond, let's say, that 1% is what's called nominal yield. What if inflation's actually 2% per year, but you're only getting 1% coupon on your bond? You actually have a negative interest rate in reality. Even though you're getting your 1% payment per year, if inflation's 2%, your real return is negative 1%, June, when you factor in inflation, because your interest is not keeping up with the loss of purchasing power of your dollars. So a nominal bond paying 1% could have a negative real yield when you factor in inflation. So my guess is, if inflation bonds are currently yielding negative, that's the phenomena I just mentioned. When you factor in inflation, the nominal interest rate is tiny, then there's some inflation on top of it, the yield's going to be negative. So if you're to buy a TIPS bond that compensates you for the loss of purchasing power for inflation, then yeah, it makes sense that it could be negative when nominal yields are so low to start with. If nominal yields are close to zero and inflation is anything other than zero, your net inflation adjusted return is going to be negative. Therefore, a TIP bond will reflect that. June. David Meyer says the industry writes obituaries for the 60/40 portfolio on a regular basis, and it keeps working amazingly well. Exactly. My thoughts exactly, David. I understand and I get what they're saying. Interest rates are low. There's nowhere else to go but up, which wouldn't do well for bond prices, which is true. And let me go back to bond funds. So when you own an individual bond, let's say it's a 30-year bond that has a lot of interest rate risk. If interest rates rise, that bond price will drop a lot. If you own a bond fund, you own a whole collection of funds that are of bonds where the bonds are getting bought and sold on a rolling basis. So the interest rate risk of a bond fund, in my view, generally wouldn't be as bad as the interest rate risk of an individual bond. Plus, even though the bond prices may fall as rates rise, the new bonds that are coming in the portfolio will have higher coupons, higher interest rates as rates rise. So those higher coupons going forward help to offset some of the lower bond prices of the remaining bonds in a bond fund. So bond funds, I think, are a much cleaner, easier, better way to help manage interest rate risk than trying to fool around with individual bonds. So anyway, so going back to why the comments about a 60/40 is dead is people say, well, the 40% part is dead because bond rates can only go up, which means bond prices are going to drop. And yes, I agree with that. But to my point, if you're properly invested in a diversified collection of bonds, as rates rise, your coupons will rise. So that sort of redeems the bonds in a 60/40 portfolio. Anyway, that's why I think the 60/40 will still continue to keep working. But obviously no one knows the future. All right. Let's see what else we got here. Dan says sailboats flip over without ballast. Damn right they do. Oh, hey, Junely, speedboats don't have ballast. Ooh, touche, Dan, touche. What do you got, Dan? Holler back, Dan. You gonna let June say that to you? No, I'm just kidding. I don't want to start a fight here, but that was a great reply, June. Alyssa, yeah, so I think I sort of touched on this, but Alyssa's question, very valid. If interest rates can only increase, wouldn't it be a bad time to invest in bonds or bond funds now? Yes and no, Alyssa. What else are you going to do as an alternative? I mean, that's sort of rhetorically, right? You can't only invest in stocks. That's way too dangerous. So you can't give up on bonds completely. Investing everything in just like true cash, like savings accounts. Currently you can get 0.6% on high yield savings accounts. So that's not horrible, but that could drop as well. So who knows? That's why, this goes to my comment earlier, Alyssa, yes, there's much more risk that rates will rise a lot than rates will drop a lot. That would not bode well for owning bonds with long remaining maturities because those bonds have the most price sensitivity to changes in interest rates. That's why I'm not currently investing in any long maturity bonds for myself and my clients. I invest in the intermediate term. Why not the super short term that have negligible price risk if interest rates change? Because the yields are simply too small to make it worth it at that point. I'm balancing the risk reward trade-off of let me invest in bonds with slightly higher maturity. So the average is like 5 to 6 years for the bonds I generally use, the bond funds I use. which means their coupon and their interest is slightly higher, but they do run a little bit more interest rate risk if and when rates start to rise. But again, there's a reason your portfolio is some stock, some bond. If and when interest rates rise, yes, your bonds may get hurt a little bit, but generally speaking, the stocks should start to do well, do better when interest rates rise, when inflation rises, Alyssa. So you can't look at equities and bonds in isolation. There's a reason why there's prudent portfolio management approaches that have, a mix of both, because each part plays its own important role in your bigger picture. But completely valid question, Alyssa, but I think it would be not wise to completely give up on bonds, in my opinion. There's things you can do to mitigate, like, again, stay away from the longer term maturity bonds. But outside of that, I wouldn't give up on bonds. Mm-hmm. Okay, I'm starting to get a little hoarse here, so let me just cherry pick some other comments here to address. I had like 4 hours worth of phone calls today and now tonight, so my voice is a little worn out. Okay. Debbie, can you speak about correlation between corporate bonds and equity? Yeah. So I touched on that earlier, Debbie, not to cut you off. Great question, but go back, look at the replay that was discussed earlier. Yes, there was correlation between all assets that have risk, stocks, bonds, corporate bonds, whatever. So they did drop. Stocks dropped more than bonds, so they were correlated. So yes, just corporate bond. If you only have corporate bonds in your bond portfolio, it's not a great hedge or offset to equities. They'll dampen your total volatility, but they're still correlated. They move in the same direction, just to different extents. Treasury bonds typically move in opposite directions of risky assets like stocks and corporate bonds. So treasuries are really when you have a bond portfolio to offset stocks, you really should have some treasuries in there. But as I mentioned, the tough thing is treasuries, because they're so low risk, default risk wise, the yields, the interest they pay are just so low. So you kind of have to get a little bit into the risk spectrum with corporate bonds to try to juice up your returns a little bit without taking on so much risk that you're basically just investing in other stuff that's as risky as equities. Good points. Mavis asks, bond funds don't ever really have an end date, right? Correct. She recognizes individual bonds inside will. Yes. Not until the fund manager decides to give up and walk away. But yes, the fund itself will not have a predetermined end date. The bonds inside of it will, which is why the fund manager who oversees the fund will have to, buy and sell, replace as bonds mature, replace with new bonds and whatever. So yes, the fund doesn't end, but the bonds inside it do. All right. I see Dave. Okay, sorry. So yeah, so Dave responded to Mavis. June, because yields are so low right now in intermediate bond funds, 1%, why not just put the money in a stable value fund or a short-term bond fund? At least the NAV will be stable in a shock and you can take advantage of rising rates. Yeah, good question. So not everyone has access to stable value funds, June. A stable value fund, for those curious, it's like sort of like a CD / savings account / money market account. It's stable in that you can't lose money, your principal. It has a fixed, a sort of contractual return to it, a contractual yield. And those yields are relatively high. They could be 2 or 3%. Sounds awesome, right? And they are. But they're generally only available inside large institutional plans like 401ks, like 529s. Stable value funds are technically an insurance product. It's a big contract where the participants agree to come in, keep their money in there for a while, and the insurance company will pay them higher than standard interest rates. Retail investors generally don't have access to stable value funds, outside of their 401ks or 529s or something, June. A few fund managers have tried. It doesn't really work because sort of by nature, you need a really large pool and you need some stability and consistency of money staying in there so the insurance company can afford to take the risk of paying higher rates. You need like a lockup, like a commitment. For retail investors, they're kind of flighty with their money. It just doesn't work. So if you have access to a stable value fund that pays you 2 or 3%, use it. That's a great cash investment to use. Most people don't have access to that, June. But yes, if you had it, that'd be great. Jim, what do you think of investing in Treasury bonds knowing the value will double in 20 years for a guaranteed rate of 3.7% over 20 years? A little confused by the question, Jim. What do you mean the value will double? The value won't necessarily double. So if you buy a 20-year bond today with I assume yield to maturity of 3.7%, which is I guess what you're referring. That seems high, but maybe that's the going rate. You're not actually doubling your money. You're paying $100 today. You're going to get about, whatever, call it $3.50 of interest a year. And then in 20 years, you get your $100 back. So you're not actually doubling money. If you put in 100, got out 200, that's doubling. That's not how bonds and the bond math work. But if I'm missing your question, Jim, definitely elaborate. But I don't think it's how you explained. All right, Dave Meyer's got to go. All right, yeah, looks like we're wrapped here. So yeah, thank you everyone for joining. This was I was hoping there's going to be a lot of good questions, and there definitely was. So thank you all for that. I'm glad to see you got a lot out of it. I thoroughly enjoyed this one. I love bonds. As I said, I'm a kind of academic educator at heart, and bond class was the first class I ever taught. So near and dear to me in a weird, geeky, nerdy kind of way. All right, we'll leave it there. My voice is running out. Thank you all for joining, and I will see you next week. Take care.